Hello, hello, hello. I'm live on Massive Mortgage Education and also live on YouTube. I'm continuing my series with having to do with credit and my 40-page document. That's a lot of really great information as far as credit scores. And where we left off and where we were going to pick up was the 5 factors that determine your credit score. So that's where we're diving in right now. Hope everybody's having a super great day. So the 5 factors that determine your credit score, maybe we can add that light because this camera is super, super dark. Oh, look how smart that is. Now I can look up and down. It's so much easier. For some reason, that one's super, super dark, so we might need to add that second light. But okay, payment history. Number 1 is payment history when it comes to the 5 factors that determine your credit score. This is a history of bills that are paid on time, hopefully, that would help your credit score, while late or missed payments are going to cause you to have a lower credit score. And the payment history, which is so huge, and I have seen this over the last 18 years, the payment history is the single biggest scoring factor, accounting for as much as 35% of your FICO score. 35%. So what I've seen is, I've seen people that have had literally absolutely excellent credit and pay one bill late and drop 40, 50 points. I have seen people with an 800 credit score pay their mortgage late by 30 days and drop their credit score 100 points. So I've seen this firsthand in helping people with their financing and reviewing credit. And payment history is going to be number 1. It's noted as number 1, and that is for a really good reason, because it's a really big deal. So, think about this. When you have credit cards and you have minimum payments and things like that, right? That is going to be something you really want to focus on paying. I've seen people really mess up their credit by missing payments on a credit card where the minimum payment was $25. Like, don't let yourself get stuck in that trap where you're missing a payment and it's really just making the biggest difference. Number 2 out of 5 is credit utilization. Credit utilization is the amount of available credit you're using. To determine your utilization ratio, add up your outstanding balances on credit cards or revolving accounts and divide that sum by the limits on those accounts. Then multiply by 100 to get your utilization percentage. So if you owe $2,500 on your credit cards with a total limit of $10,000, then your utilization in that instance is 25%. Now, and this is directly from the bureaus, and this is what I preach as well. Experts recommend keeping your utilization below 30% to avoid substantial and rapid decreases in your credit score. So if you have a credit card or a revolving account, which is typically a credit card, then you want to keep that balance at or below 30%. So if that limit is $1,000, you never want to have your balance more than $299 at any given moment whatsoever. All right, number 3 is going to be the length of your credit history. Your credit scores will tend to rise over time as you gain experience in handling debt. If you've only been using credit for a few months or years, you can't really do anything to accelerate that, right? But establishing a record of timely payments early on with life will help you benefit a lot. It'll really benefit you a lot. The length of credit history can constitute up to 15% of your FICO score. 15%. Can you flip that without having to hold it? Be bothered? It wouldn't work the other way. It was not like
you were sideways.
Oh, I was sideways. Sorry, everybody. Let me see if I can just take it off and lean it on up against this screen.
Okay.
See if I can do. Okay, there we go. Oh, look at that. Okay, great. Even better. All right. So number 4 of the 5 factors determining your credit score. Number 4 is credit mix. Credit scores reflect the total amount of outstanding debt that you have and the types of credit you use. A variety of loans, including both installment loans and revolving credit, can lead to a higher credit score. Credit mix can influence up to 10% of your FICO score. Up to 10%. So You don't just want to have credit cards. You don't just want to have auto loans. You don't just want to have mortgage loans. Like, you want to try to have kind of a variety of things. But I'm not saying to go get in debt. When it comes to credit cards, I believe in always paying them off in full every single month. You always want to utilize their money for free for 30 days if possible. What I mean by that is, if I charge on my credit card and I pay that balance off in full when that bill comes in, I'm going to pay no interest. But here's the trick where people mess up and where the credit card companies get you. If I have $1,000 limit and I charge $500 and I pay $490 off, I left a $10 balance. My interest charge is on $500, not on my $10 that's left. So make sure you're doing that and using that wisely. And last but not least, number 5 for the 5 factors determining your credit score is recent applications. And this is something that's very important to be able to go through, because I have this conversation 100 times a day. When you apply for a loan or credit card, you trigger a process known as a hard inquiry, in which the lender requests your credit history and often your credit report as well. Hard inquiries typically can have a small, short-term negative effect on your credit score. As long as you continue to pay your bills on time, your credit score will typically rebound quickly from the effects of hard inquiries. Checking your own credit is a soft inquiry, so you can check your own credit as often as you want. Like, check it all the time. You want to make sure that no one's stolen your information or someone's not reporting you late when you weren't late. Those are the kind of things that happen all the time. Recent credit applications can account for up to 10% of your FICO, but they're never the sole reason an application is declined. So I'm going to go off on that little tangent for a minute before we move on with this lesson. I do find it a little bit interesting that so many people, they'll go to buy a car and they'll have their credit pulled 5 or 6 times and they don't think anything about getting it pulled to buy a car. Or they'll run through the, let's say, Target or Steinmart or whatever, make up the name. And it's like, oh, well, you spent $500. Do you want 10% off? Well, I sure do. Pull my credit. And people do this stuff all the time. But then they call us to get a mortgage loan and say, well, I don't want to pull my credit. Well, that's like calling the dentist and saying, hey, my tooth hurts. Can you fix it over the phone without looking at it? No, it's silly. If you want a mortgage pre-approval, we have to do a hard credit pull in order to even run it through Fannie Mae, Freddie Mac, Gus for RD, and these different softwares that we have to use that determine if a loan is approved or not, right? And we have to have hard credit pulls in order to do that. So if you are not having a lot of people pull your credit for a lot of different reasons in a short period of time, and you go to apply for a mortgage, it's not going to have this horribly negative effect on your credit score. Here's where the big problem lies, is that people call and say, well, I have a 705. And then the mortgage lender pulls it and they say, you have a 660. Oh my gosh, my credit is horrible. It's ruined because you pulled my credit. Nope. It did not drop like that because your credit was pulled. You're looking at one grading scale and we're looking at another grading scale. It's like as if you're in high school and Slidell High is at a 10-point grading scale and North Shore High is at a 6-point. Do either of those schools care at all that your grade would be different if they were on the opposite scale? No, they don't. And that's the same thing. When you're pulling your own credit, when you're doing all these free credit apps, they're most likely giving you a Vantage score, which is not in any way relative to a FICO score that a mortgage lender is going to pull. So we're looking at something different and we're pulling something different. And that is always an all-day conversation that we have, that no, your credit didn't drop. I know it's different. I've seen it be as much as 100 points different. And hey, y'all that are watching, I have a quick question. Carla, Riley, Deborah, hi. Can y'all hear me okay? Can y'all give me a thumbs up? Because I realize when I'm putting the phone on the computer, because I was sideways before, I'm wondering if it's muffling the sound because it's sitting on top of the computer. So if y'all can hear me okay, can you give me some thumbs up just to make sure that I'm good on that end. All right, so we're going to move on to the next part, and that is how negative information impacts your credit score. Let's see. Okay, good. All right, so how negative information impacts your credit score. Certain negative entries on your credit report's payment history can severely lower scores for extended period of time. Depending upon the nature of that information, the score impact of these negative entries diminishes over time, but initially at least, they can outweigh all other factors and severely drive down your credit score. So these derogatory entries include things like settled accounts. A creditor may agree to accept less than the total payment that you owe, in which case your debt is considered settled. However, because you didn't repay the debt as agreed, settled accounts are still considered negative. Collection accounts. When a creditor feels they can no longer recoup a debt, they may hire a collection agency to try to get you to pay, or they may sell the debt outright to a collection agency. That is going to also negatively impact your credit score. So you want to try to avoid that anytime possible. Charge-offs is another thing. A charge-off is when a creditor charges off a debt. It means they've decided that they won't be able to get the money you owe, and they've written off your account as a loss. They may then still sell the debt to a collection agency. And that can cause a real big mess because now you've got a late payment, charge-off, collection, and it can just send you down this rabbit hole of things that you have to work on and fix. So definitely try to avoid settling, avoid collections, avoid charge-offs. The next thing is repossession. When a creditor reclaims collateral for your secured loan, such as the vehicle that you purchased with an auto loan, this account status will be noted on your credit as a repossession. So not only is it negatively affecting your credit as a repossession, but guess what? Most people don't seem to know until we tell them because we're dealing with their credit. If I go buy a car for $30,000 and I finance it, and then I decide that I can't pay the car note anymore, so I think I'm just going to, they're just going to show up at the door and they're going to repossess it because I haven't made payments. There's TV shows for that, right? And so they're going to take it back. Well, then a lot of people think, well, I'm done. They took it back. I'm done with it. They've got their car. Well, if I owed $25,000 on that loan and they now go sell that car at auction or wherever for $15,000, there's still a $10,000 default. And guess what? I'm still responsible for that. So I'm going to have a repossession and probably also a collection on my credit to show that I still owe that money. So if you commit to a debt and you commit to a loan, then there are some major repercussions if you don't follow through with that particular commitment. Now, the next thing that negatively impacts you is a foreclosure. Equivalent to a repossession on a home loan, foreclosure occurs when a lender takes possession of your house because you haven't paid your mortgage. Foreclosures stay on credit reports for 7 years. You've got voluntary surrender. If you're unable to pay an auto loan and negotiate to turn the vehicle over to the lender, your account will note the voluntary surrender on your credit report. And to my knowledge, when they sell it short, you're still going to owe the difference, is my understanding. And then the last but not least is bankruptcy. When you're no longer able to manage all your debt, you may declare bankruptcy. When you file Chapter 7, that's when none of the debt's included. So you're like saying, hey, wipe me clean. I can't pay anybody. I need a fresh start. That notation stays on your credit for 10 years. If you file a Chapter 13, that's basically where you say, hey, everybody get together, give me some discounts. What do I owe? I'm going to pay the court one payment and everybody's going to get paid. And I'm going to, even though I'm filing bankruptcy, I'm not wiping my slate clean. Chapter 13, where you're paying some of the debt off, then that's going to stay on your report for 7 years. So it's like they give you a little bit of reprieve by agreeing to pay back the debts versus just saying, okay, I can't do anything or pay back anything. All right. For those of you who are live, if you have any questions, just type them in the comments. It should pop up where I could see it. And I'd be happy to answer those. All right, so what's a good credit score? When tracking your credit scores, looking for evidence of improvement, it's important to be sure that you're using scores generated by the same model. Remember, I said a lot of those free apps use Vantage scores. Some do use FICO scores, but generally not the FICO, what's the word I'm looking for? Like the FICO version, like the FICO 9 or 8, whatever it is actively. That a lender is going to use. So even if you're getting a FICO, it's probably still not the same FICO that a mortgage lender is going to use. Let's see. Yeah, so we're talking about make sure they're generated from the same model. With that in mind, here's how the FICO breaks down the median of the scores generated using the scale range of 300 to 850. So 300 would be poor and 850 would be exceptional. I have seen thousands and thousands and thousands of credit reports, and there are not that many at all that I've seen over 800. So I get kind of excited about that. So poor is going to be 300 to 579. Fair is going to be 580 to 669. Good is going to be 670 to 739. Very good is 740 to 799. And exceptional is 800 to 850. Now, this is according to the Ultimate Field Guide, Understanding and Improving Your Credit, that I've got in the link below, that full 40 pages. When it comes to the mortgage lending perspective, the target does change. I've seen the average credit score be 680, 700, 710. It looks like lately it's the average credit score is hovering around 700. And so anything below that would be below average. When it comes to mortgage lending, if you're at 740 or above, it doesn't matter if you're at 799 or 850. If you're above 740, you fall in the same bracket and generally get the same bucket of interest rates. And it would definitely be the best available interest rates because you have the best available category, if you will, of credit score. All right. So now we're going to go to 4 ways to establish credit if you have no credit. Now, if you're looking to buy, sell, or refinance, we can help you at the Weeks team. We're available in multiple states. Whether you're moving in 9 days or 90 days, give us a call, shoot us a text, or send us an email so that we can help you with your financing. We've got hundreds of reviews online on the different platforms, and every one is 5 stars. So that should say something. So give us a shot. All right, 4 ways to establish your credit if you have no credit. As long as you maintain good credit habits, paying your bills on time and avoiding excessive use of credit cards and other revolving credit, you're likely to improve over the course of your life. Your credit is likely to improve over the course of your life. But everyone does have to start somewhere, and unfortunately, this typically creates a problem. If you don't have a credit history or any data to draw from, the lenders might be hesitant to lend you the money because you'll never establish your credit if they won't give you a chance, but then it's hard to get the chance. So we're going to talk about what you can do. And I want to put that kind of in layman's terms. I'm going to go back to high school again, right? Because most people have experienced that. Going back to high school. When you start out, you have a 0, and then you have exams, which are a higher percentage of your average, and then you have homework, which might be a lower percentage of your average, and you have quizzes, daily participation, things like that. So you start out at 0 when you don't have anything, but then let's say they do a couple quizzes and you've got some grades, and then you throw in an exam, and that can really affect you positively or negatively how you did on that exam, things like that. It's kind of the same philosophy. You start with nothing. And so you've got to start somewhere. And then the more that you have and the longer that you have it, that then is when you can start to establish more established credit, establish a credit score, and hopefully a good one. So the number one way to establish credit if you have none is become an authorized user on an established credit user's account. A parent requesting a card for use by their child can help the youngster establish a credit history. The primary cardholder will be ultimately responsible for the payments, so be sure they have a positive payment history, and discuss whether you can use the card and how your payments will be handled. Here's my 2 cents on that. If you are getting to be an authorized user on a family member's credit card to protect you both and to protect the relationship. Get authorized, but don't even get a copy of the card. Don't use the card. Don't charge on the card. It's their account. You're just trying to ride on their coattails. But here's a big step that a lot of people miss. If they have maxed out credit cards and they don't have good credit and they have late payments, please do not be an authorized user on their account. You're not helping yourself. I feel like this is a partial truth where they're missing some sentences. So what should be added to number 1 is, if their account has been open, ideally for several years or more, if the account has remained in positive status for at least the last 24 months, and if the account has a low revolving amount, meaning if the limit is $1,000, we don't want a $900 balance, we want a $300 or less balance. A lot of things with lending and credit, I feel like, is a partial truth where they're like missing these extra sentences that I feel really, really need to be added. All right, the number 2 way out of 4, open a credit account jointly with an established credit user. If you're over 18, a parent, spouse, or friend can apply for joint credit with you. The loan or credit card account will be listed in both of your names, and the usage and payment activity will appear on both co-signers' credit reports. A word of warning, big flashing red lights. Both parties' credit will suffer if the card is misused. So sometimes you don't really want to do this option, because if they're not going to pay the bill on time, or they're going to pay the bill late, or they're going to max out the card, you're going to have the negative impact just as if they're going to have the negative impact. Number 3, which is one I do believe and support in, obtain a secured credit card. With a secured card, the borrower puts down a cash deposit equal to the spending limit. So if you go get a $300 limit, you would put $300 into a savings account that you would not be able to withdraw. Purchases and payments will be reported to the credit bureaus and can help establish a credit history. If payments are made on time and balances stay low, secured cards can be an excellent way to build credit. I do think that's a good idea. And then number 4 would be get a credit builder loan. This is a special type of loan available mainly from credit unions and small banks. It's designed to promote savings and help you establish or rebuild a positive credit history. Instead of giving you the borrowed sum to use, the lender places it in a savings account that you can't touch. As long as you make the payments on time, when you've repaid the loan in full, the borrowed sum is released to you, possibly with interest. That's really good. All the while, your payments are reported to the national credit bureaus, helping you establish a positive credit history. Now, if you miss payments, that will reflect negatively on your credit, and the lender can take back the funds and they can settle out the loan. When researching credit builder loans, make sure the provider reports payment to the credit bureaus, because I've seen that. If they're going to do it, but they're not going to report payments to the bureaus for like over 12 months, I mean, if you're in a long-term situation, then okay, maybe that's fine. But ideally, you would want someone or a lender who's going to start reporting those payments within like after that first couple payments, so 30 to 60 days as an example. Anybody have any questions? Everybody's super quiet today. All right, next topic, we're on page 27 of 40. Next topic is how marriage and divorce affect your credit score, or impact your credit score. I stand corrected. While marital status is not reflected on your report and it's not reflected on your scores, the credit activity of one spouse can have consequences on both, even if it occurred before the marriage. When married couples apply jointly for a mortgage, car loan, or other credit, as they must if they want 2 incomes taken into consideration, both parties' credit histories are also taken into account. If one has a low credit score or a spotty history, that could translate to a higher interest rate or even more difficulty getting the loan in the first place. And when a couple has joint credit, both parties' credit reports and credit scores are affected by the payment activity or the lack thereof it. If one spouse maxes out a joint card, for instance, it's going to hurt both spouses' credit score. As a prelude to marriage, it's a good idea for couples to have a frank discussion on their credit histories. And my friends that are single, they joke. But when they're like, oh my gosh, this guy's so great, and da-da-da-da, and I'm like, well, did you pull his credit? Because that's going to tell you a lot. And I still believe that's true. So this will help you avoid surprises and perhaps start a conversation about avoiding the repetition of past financial mishaps after tying the knot. Keep in mind that marriage does not combine a couple's credit reports. You still have your own single credit reports. Both spouses continue to have their own individual reports even once you're married. When a couple that has joint debts decides to split up, it's critical for both parties to make sure that bills continue to be paid as agreed during and after divorce proceedings. Even if a judge's order one spouse to pay the loan, failure to do so will hurt both parties. All right, stop on that for a second. If you're getting divorced and you have cards or bills, and even if the judge says that the ex is responsible for the debt, you better be keeping yourself apprised on that account. And if it's about to be paid late and they haven't done it, I know it sucks and I know it seems stupid. You better make the payment, because there are so many times that people come to apply for mortgages and their credit is totally shot because the ex, who if was so dependable, you probably would still be with them, the ex didn't make the payments that they were supposed to make, even per the judge's order. I know you're all shocked by that. None of us can imagine anybody doing that, but it happens all the time as I see credit reports. So you want to be super careful with that. If possible, it's often wise for divorcing couples to refinance joint loans as individual debts. So just get it out of their control as fast as physically possible. It's crucial, especially after long marriages end, for both parties to begin building up their individual credit profiles. Maintaining credit cards and other loans in one's name during the marriage can make this process easier. So they're saying if you keep some of these accounts separate instead of joint, can also make things a little easier. Because divorced individuals typically come to the loan application process with less income than they would declare as a couple, securing new loans could be more difficult after a divorce. So you want to kind of keep that in mind. The next thing is, how can retirement influence your credit? And you're like, well, that kind of seems odd, right? So that's interesting to figure this one out, like how retirement can influence the credit. As retirement approaches, individuals' debt levels often taper off. Mortgages may be paid off, hopefully so, that'd be amazing. Cars may get replaced less frequently, and credit cards may be used less often. A lack of credit activity over many months can cause an account to be dropped from score calculations, possibly hurting the credit scores. Basically, lack of utilization. It may cause a credit card user to close the account, which could cause your credit score to decrease due to less available credit. So you want to kind of keep that in mind as well. Retirement can also affect your ability to get loans, since lenders often look for steady income when considering applications. Now, don't let that scare you, because we deal with lots of retired people. I mean, you've got interest income, dividend income, we've got pension, Social Security, disability, and lots of other income sources. So don't just assume if someone's retired that they can't get a loan. But because retirement often brings a reduction in income, it may affect your ability to get a certain loan or certain types of loan. The significance of a smaller income is its role in increasing your debt to income ratio. Lenders often consider debt to income, which you can calculate by dividing your monthly bills by your monthly income, along with your credit score, employment history, and other assets that you may have. Those are all things that are going to be taken into consideration when it comes to giving you a loan if you are in the retirement stage. A drop in income will typically mean an increase in debt to income. Lenders typically look for debt ratios below 43% when considering loan applications, though some may require lower ratios. I'm going to talk about that with mortgages. When it comes to VA, sometimes you can have a 60-something% debt ratio. When it comes to FHA, sometimes you can have a 50-something% debt ratio. When it comes to they really want you to be at that 43% mark, so they're right on the money there. When it comes to conventional, depending upon the entire file, sometimes a 49% debt ratio is just fine. Just thought that little tidbit was important for you to have. No matter what your financial picture may be, you can take control of your credit behaviors and manage them successfully through all of life's ups and downs. All right, we're going to talk about a myth and we're going to talk about a truth. Here's the myth. Carrying credit card balances each month help improve your credit scores. Truth. Paying off your credit balances or your credit card balances in full as quickly as you can will save you money and could benefit your credit score. No pain, no gain may be a truism for gym workouts and marathon training, but it's misapplied when it comes to building credit scores. Carrying an outstanding debt, credit card balance typically induces financial pain in the form of interest charges that get tacked onto your balance, which can accumulate quickly over time, depending upon the size of that balance. That comfort yields absolutely no benefit for your credit scores. In fact, if your outstanding balance exceeds about 30% of the spending limit, like I talked about earlier, then your score could actually fall because of that. If you're carrying a balance because you can't or choose not to pay off right away, try to keep your balance under 10% of the limit. Remember, the rule is definitely under 30, and here they're saying under 10%. Sorry. I've been talking since 7 a.m. and my voice is cutting out completely. Part of the convenience of credit cards is flexibility to take more than 1 month to pay off a purchase and not have to pay cash for something. Just gives you a little reprieve when you use those credit cards. So it may not be possible to pay off every credit card balance in full every month, but never forget that you're paying that for convenience and to avoid interest rate charges. You want to pay it off quickly, quickly, quickly. All right. So I think we're going to wrap up there for today. We're going to pick up next time with 6 ways to take control of your credit. If you're here on the Facebook Live, this was my third video. There's the word for you. Third video discussing credit. It's a 40-page document I've gone through. The Ultimate Field Guide, Understanding and Improving Your Credit directly from experience. Very informational. I'll drop the link to the whole thing. A lot of these videos, I'm interjecting my mortgage experience. I'm interjecting my opinions and what I've seen. So the videos are definitely more detailed than just the 40-page document. But where we're going to pick up next time is the 6 ways to control your credit. And if you missed the first 2 for the Facebookers, those are on the YouTube channel. Thank you all for tuning in, and I will see you all soon in the next one. Why does it literally never fail?